Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me in the studio is my friend Niklas Sävås. How are you doing?
I'm really good today. Have had some holiday and also reflected a bit about both life and investment matters over the holidays and over the new year.
Something specific that stood out from those reflections?
I think the last year has had a common thread, and that's becoming maybe less focused on the stock market and focused on stock prices and more on businesses and actually doing the research on businesses. So that's something I take with me.
Yeah, we have really been influenced by all of our great guests. And today comes an episode with another such person. It's Dennis Jean-Jacques. He is a seasoned investor and author that reached out to us after listening to the podcast. Currently, Jean-Jacques is President and Chief Investment Officer of Ocean Park Investment, an alternative asset management firm based on the US East Coast. Jean-Jacques has a really impressive background. He first worked as an equity analyst with Peter Lynch and other legendary investors at Fidelity in the early 90s. He then received his MBA from Harvard Business School before apprenticing with Michael Price on special situations. From 2005 to 15, Jean-Jacques was a portfolio manager focusing on absolute returns until he founded Ocean Park Investments in 2016. His work has been featured in top financial publications, including Barron's, Fortune, and MY Global. And Jean-Jacques is also the author of The 5 Keys to Value Investing, published by McGraw-Hill in 2003, and the book we will talk more about today. So, Niklas, how does the 5 Keys to Value Investing fit with our quality rating here at Redeye?
So I think The 5 Keys is a book for those that are early in their careers and would like to understand the most important things that you need to have as an investor. So how to evaluate if a business is good, what to look for in a manager, if the price is right, and also possible events that can lead to a rise in the stock price. So I think it could be used as a handbook. And as equity analysts at Redeye, we use a quite similar approach where the Redeye quality rating is our checklist in this evaluation.
Yes, and on the Redeye website, redeye.se, we recently introduced the concept of timeliness. And this is based on future events or catalysts that should drive the stock to its fair value. What did you learn about this concept from the book?
So catalysts is something that I've studied a bit before and thought about. But I think compared to other books, this book stands out because there's a whole chapter dedicated to catalysts. And both potential operational improvements and potential M&A and spin-offs are mentioned. So I think it takes a bit of a broader approach than others. And I think it's a key subject for investors and something to study deeper because sometimes you can buy a stock at a cheap price, but without the catalyst, it may stay cheap for long. So investors should clone the ideas in this chapter and potentially use them in a checklist approach.
And besides catalysts, I think there are many other lessons from the book. And beyond the book, I really hope and think that our conversation with the author can provide many new insights on how to become a better investor. Here comes our conversation with Dennis Jean-Jacques. Hello, Dennis, and welcome to Investing by the Books podcast.
Well, thank you for having me. I really appreciate it.
Where are you today?
I'm in Stamford, Connecticut, in the United States, and it's a little bit nippy outside. But we had a good snowfall, but it's all the streets are cleaned and clear.
Nice. Today we will talk about your book, The 5 Keys to Value Investing, and I want to start off with the acknowledgements where you highlight the importance of great individuals at Fidelity and Mutual Series Fund. What did you learn from them and the firms?
Yeah, I had the opportunity to work with, pretty amazing people at Fidelity. People like Jeff Ubben, Catherine Collins, Peter Lynch, Vinnick. I noticed very early on that there was basically no one way to make money in the markets. Everyone has their own styles, but above all, I think what I took away from that experience was really understanding and appreciating the apprentice kind of culture that Fidelity had, which is basically always learning, always seeking advice, and always seeking information wherever it could be found.
So outside of the firms, what investors have most influenced your thinking?
Well, early in my career, I remember I wrote a letter to a couple investment legends, and actually, John Rogers at Ariel actually wrote me back, and so we met. Every time he would visit Boston or so, John gave me a lot of very, very good advice early on in my career. I think one of the most important is that, he basically gave me the advice to read everything I could about Warren Buffett. So while I was at Fidelity, I would kind of go to the library and read, the annual letters and the Buffett partnership letters. After Fidelity, I attended Harvard Business School, and during my first year, Warren Buffett, spoke to our class, and it's interesting because I was right there in front row, and he really had really thought-provoking, things. I remember one of the things that he asked us, which kind of, he posed a question that I think which I will never forget, which I think basically changed the trajectory of my career. Basically Buffett asked, he posed a question like, why would someone, sell a perfectly good business generating lots of free cash flow? Why would someone sell it at 30 to 40% discount in the market? And the thought was that maybe they could buy it back at some other time. And then he asked, what if you don't sell those shares back to them? What if you hold these shares for generations and you benefit from the free cash flow and things of that sort? And he said that was the opportunity, to buy really good businesses at great prices, to really take advantage of the market's, volatility. And so that was an interesting kind of, thought process going, when he visited. And I called it kind of my rational awakening when I was there. And after graduation, I worked for an investor named Michael Price, which is where I started my career in value investing. So I would say, John Rogers, Warren Buffett, Michael Price, and later Othamo Leon had the strongest impact on me early on in my career.
And I just want to ask, at the time Buffett came, was it like a really huge event when he came? Or, how many in the class really knew about who Buffett was and his record?
Yeah, no, it was huge. It was everyone basically lined up before the doors opened. I tried to get a front row seat. So it was very, it was just mind blowing. I mean, the things that the advice he was giving us, and he does this all the time in a lot of different business schools. As a matter of fact, I had an opportunity to thank Warren Buffett in 2000 in Omaha during his annual meeting, which actually was captured, I think, on YouTube or something of that nature, where I thank him. I told him that I really appreciate him visiting schools, and he was pretty grateful for that.
This must have also affected your whole life, not only in investing and your career, I think.
No, absolutely. I think there's value in proximity. So being close to someone, and after he spoke, walking down and just being within a small circle of people around him and just seeing his movements and gestures, you realize that he's a person just like you and me. So it's that was kind of allowed me to say, maybe this is something I could actually pursue and do well in.
And he has really given back his knowledge to other investors, and you have too with your book. The 5 keys to value
absolutely,
investing.
Absolutely. Helping others and also explaining it, what you've learned over your career is another way of basically solidifying all the lessons you've learned over the years of a career.
So why did you choose to write it? Was it more, just as you said, to maybe learn yourself around the whole journey, or was it to help others, or both?
Yeah, when I started, the book basically started as a faculty-sponsored research paper during my second year at Harvard Graduate School. I basically re-engineered several investments made by managers that I highly respected at the time. So I looked at investments made by Buffett, John Rogers, Richard Rainwater, Carl Icahn, Michael Price. And actually, my professor suggested I take a look at a guy named Seth Klarman. And the reasoning partly is because, this is like over 20 years ago. So, Seth, was a graduate of the business school, and also was an analyst for Michael Price. So he thought that would be a good person to add as well. So basically, for the project, I basically try to come up with questions that these managers might have asked themselves at the time they were making their investments. So I read their letters, articles about them and certain investments that they were making. And so, I tried to think about what kind of questions were they asking in that environment. So, questions like, what are normalized earnings? What's the market share of the company? How much debt does it have? What's the cost of capital, unit economics, things like that nature. So I came up with about 200 questions. So I basically wanted a checklist, but the list was very, very long. As a matter of fact, the title of the paper was something like, the value investing checklist. But I noticed that those questions fell into 5 different buckets: price, business, value, catalyst, and margin safety. So it seemed that each investor, as I learned more about them, they kind of leaned on one or two of those buckets. And each of them had their own different styles. It was much more fluid than I thought. Buffett went from, for example, he focused on margin safety, early on in his career when he was basically running the hedge fund, and then later on he focused on the quality of the business. At Berkshire, Michael Price would focus a lot on catalysts. Seth Klarman, margin safety. I would think, John Rogers and the late Marty Whitman. They like good businesses, cheaply priced. But the key was that their styles kind of fit their personalities and how they were wired. And that's one of the things I kind of learned as I got to really understand what made these people tick. And so that was the reasoning. And I think the reason why I wrote the book was really for the active owner of businesses, is really for both the novice person and also the professional. I wanted a more practical framework that could withstand the test of time. So I did not want kind of like a step-by-step kind of thing, but more of a framework where you, based on how you're wired, you could basically lean on one key versus another. And I think that was achieved.
And you mentioned these 5 keys. And how should an investor or a reader look at those? Because in the book, I get the impression that you're searching for all the 5 keys in one investment, or how is that working?
Yeah, no, that's a great question. So the 5 keys are basically a kind of a blueprint in terms of trying to figure out, do you have a sense of which all these keys? Did you go through all these keys? Whether it's the business, is it a good business? The price, which is why is this market offering me this at this price at this time, and try to understand that. A value, which is kind of what is this business worth? And there are different metrics you could use in terms of trying to figure out what the business is worth. The other key is catalyst. If I think the market's offering this company at $10 and I think it's worth $30, what is it going to get there? Are they going to break up? Are they new? Are they coming up with a new product? Are they going to new markets? So what's going to catalyze a stock from $10 to $30? And lastly, margin safety. If I'm wrong, if I buy at 10 and I'm wrong, will the stock go to 2 or will it go to 8? So try to figure out and how much one could lose. So it's really about situational, based on the type of investment that you're looking at. So if you're looking at a large cap, highly liquid, well-established company that's been around for 40 years, maybe margin safety is not that important versus the quality of the business, or even what's really going to catalyze the stock. On the other hand, you can look at a very cheaply or really small company. Maybe they have some debt issues. Maybe it's a turnaround. Maybe margin safety at that situation is more important, where a lot can go wrong, and if it goes wrong, does the stock go to 0, or does it is there a buffer there or liquidation value that could basically lean on? So it's all situational, and that was the intention of writing the 5 keys to value investing.
And I want to dig in a bit to the subject of catalysts, because I think it's sometimes a bit underappreciated. And maybe you can describe a few sources of different catalysts.
Yeah, when I wrote the book, not a lot of people were talking about, catalysts. This is over, early 2000s. If they did, they were basically talking about like one-time catalysts. But in the book, I noted that catalysts can be, yes, they could be one-time events, but they could also be ongoing events. It could also be internally generated, and it could be externally induced as well. This is one of the kind of lessons I kind of observed over time. Even when I was looking at the investors in the book, one-time catalyst could be kind of like a spinoff, right? Or maybe they sell a division, or they IPO or monetize something, and you get a big pop in the stock because they have this cash flow coming in. Then you could have ongoing catalysts, such as, let's say they have a new manufacturing process where they could take out a lot of redundant costs and increase the yield of a product, or maybe have better procurement. Or it could be something like, instituting more entrepreneurship kind of culture where all stakeholders are benefiting from the company and the business, and just productivity just kind of gets better. So you could have, in the book I have this 2x2 where I show the internal external catalyst and also ongoing one-off catalysts. So I think that's the better way of, or one way I should say, of looking at catalysts.
Yeah, and I think that makes it really interesting, because I think the most common ones that are discussed are the ones like spin-off or an asset sale or an activist coming in to the business and so on. But you mentioned all these operational improvements, which is not always discussed as a catalyst, I would say. But I definitely agree that they are, because they show the actual value of the business.
Yeah, our CEO is usually talking about soft catalysts where there is no date that you can see that it's going to happen, and then you have hard catalysts with a specific date when a spin-off is happening or something is going on. So one interesting aspect that you bring up in the book is time, and you call it the silent external catalyst. Can you explain a bit what that is?
Yeah, I've noticed that many good corporate strategies often need to reach an inflection point before expected profits just start to flow and spur stock price appreciation. Sometimes a combination of time is basically best to catalyze those profits. Bill Miller, legendary value investor, often referred this as time arbitrage. The key for investors is really to identify the source of returns, and if those resources, or if that source will clearly benefit you with time. It could be going into a new product area or going to a new market, where you just need time for clients or for revenues to start picking up to build momentum. So time, in essence, could be a very silent catalyst. It often doesn't show up at an immediate moment, but over time it does.
And related to that a bit is when you write that an investor should never chase a stock, and you bring that up in the first chapter's case example, which is a spin-off story. So what do you mean by that investors shouldn't chase stocks?
Yeah, it's really about behavior. It's about the FOMO, fear of missing out. As humans, we are kind of wired a certain way. Chasing a stock is basically buying a stock purely on the stock price appreciation momentum. Look, I mean, it's okay to buy shares of a company on the way up if you could fully capture and understand the reasoning behind the source of returns. Maybe it's because margins are starting to grow and you think it's going to really expand. Maybe they're gaining more share than the markets and yourself previously anticipated. I think those are good reasons, and those are not chasing the stock. Chasing stocks are really going after a stock because it's going up. You don't really understand or fully grasp why the source or why the fundamentals behind that. So chasing a stock is really basically buying on price momentum alone.
Yeah, some things just take time, and we need to be patient. So we know that one chapter was left out of the book, the analogy.
Yes.
Can you tell us a little bit about that?
Yeah. So it's interesting because the project originally had 9 9 chapters. Chapter 8 was supposed to be basically 2 chapters. Chapter 8 was idea generation, and chapter 9 was going to be about building a portfolio. So the original chapter 9 was cut short because I had this analogy that that I guess did not go over very well. I called it a conversation with the Madam Index. It's basically a play on. It was a play on Ben Graham's Mr. Market. So in the early, it's interesting. In the early 1990s, Jack Bogle was was touting and talking about the Vanguard S&P 500 index. Coincidentally, by the way, Jack Bogle also visited my first class as well, talking about indexing and things of that sort. So anyway, this fictional Madam Index character that was kind of like that put in this chapter was basically a portfolio manager, and she runs an index fund. And, she beats, 80+% of the managers. And so I had this conversation with her. Obviously this is kind of this fictional character. And so I basically asked her, how does she do it? And then, there were a few things that came out of that interview. Madam Index told me that she only focuses on 3 areas. She focuses on stock selection, basically focuses on the quality of the business. She talks about how she picks her companies. And basically these are dominant or semi-dominant companies in their respective markets, large dominant companies that basically can raise prices or squeeze raw material vendors, or basically just really profitable large companies. The other area that she told me she basically focuses on is basically duration. So, she wants to hold on to these great companies for the long term. She does not have, a price target for these companies. She doesn't have a fair value target. She doesn't have stop losses or anything of that nature. She just let these dominant companies do their thing. What was not lost on me, however, when I was speaking to her, is that, she structured her business so that she could have this kind of patient capital for her to be able to do this. And the last thing that she talked about is really about risk management. She was not a daily trader. Her portfolio was very, very diversified. She had small positions and rebalanced them, the portfolio occasionally. So that was kind of like the way, I had proposed this interview to go. What was surprising to me was that Madam Index did not know the valuation of these companies in her portfolio. She did not know whether they had catalysts or did not have catalysts. No real earnings projections. She didn't really know what the companies are worth. It was not as meaningful as far as understanding what the quality of these businesses are. And for her, it was all about structuring a portfolio that would allow her to hold on to these great, high quality, dominant companies for the long term. And that was basically a very good lesson that I learned from Madam Index. And today, professional managers try to come up with ways to beat her, and to compete with her. They'll say, well, perhaps I could win in stock selection, maybe risk management. They'll buy companies and try to figure out maybe there's a catalyst here or there, or I'll become an activist in all my companies to try to unlock value, so to speak. Or maybe I'll just buy all companies that are just cheap, But for some reason, the way that Madam Index structured her portfolio, the way she select her companies, the way she managed her risk, is pretty superior. Look, having said that, in the book I outlined, managers that beat the index, and by focusing on their own two areas. Madam Index focus on quality, and that's her main focus. Other people may focus on catalyst, but again, it's really about how you're wired, and you could do well in the market if you know exactly what you're looking for. So anyway, that was the way I was thinking about it.
Yeah, when I hear this, I think about the coffee can approach that we talked with Chris Mayer on one of our recent episodes. And
what was the coffee can approach? What was that?
It's that you put you choose maybe 10 stocks and you put them away for 10 years and you don't open the coffee can. You just put them in there and then you leave it. And then that has outperformed the market by far, usually.
Yeah, it's interesting because Fidelity did a study. I think it was this. I forget what year it was. So they said which were the best performing accounts that they had. The best performing account, well, the second best performing account were the accounts that where the account holder forgot that they had an account. That was the second best performing account. Do you know what the number one account was? That was the best performing account.
I think I've heard about this.
Yeah, those accounts where the person was dead.
Yeah,
that was the best performing account, And so you're right. I mean, buying good companies and putting it away tend to do pretty well.
It's a good lesson.
Yeah, the original article of the coffee can is by Robert Kirby. It was published in 1984, and he is giving some critique to S&P 500. That's why I thought it was interesting, because he's claiming that like several hundreds of transactions are going on in the S&P 500 every decade, and that causes some transaction costs for holders of the index.
Yeah. Wow, that's interesting.
Yeah, and also he writes that these decisions that are taken, they are not made by. It's not mechanical. It's actually individual judgments by Standard & Poor's staff. They have a committee, and that is still the case, and they make the final calls. So they're not always rational. I mean, they kept AIG, for example, after the crisis, because the 2009 crisis, because they didn't want to. If they would kick AIG out, I mean, and the government just backed it up, they would crush the stock. So.
Yeah, which is a great point, which kind of leads to the point about risk management. Having, structuring a portfolio where you could hold on to situation like AIG is just as good as finding the highest quality company. Being able to hold on to good ideas is, I think, where a lot of people sometimes fall short on, because there's a lot of great ideas. The question is, can you hold on to it for the long term? And can you withstand certain drawdowns in your portfolio, like an AIG or something, or a company that doesn't do very, very well? And I think that Madden Index have shown time and time again, having a well-diversified portfolio, having small position, tend to win out over the long term.
Yeah, and in the book you mentioned many interesting case examples where you have gained like really good returns, like 50% in just a few months or so. But you also write that you, in general, believe that buy and hold strategy is good, but duration matters, and you think 3 to 5 years is better than 5 to 10 years. So do you still hold on to that, or what is your time horizon these days?
Yeah, I like to think of holding a company for long term should be almost kind of by mistake, in that if things continue to get better, if you believe your conviction level is still pretty high, and you have to reevaluate. Maybe it's every 6 months, maybe get every year, but you should be periodically where you're reevaluating the situation. And if you look back and say, hey, I've owned this company for 12 years, well, that's fantastic. But companies change. We've seen this with large company like GE or AIG you kind of mentioned, and you have to be able to you're not going to top tick when it actually happening that moment, but maybe a quarter or two afterwards you should say, okay, well, it's no longer the same company that I purchased in the first place, or a year ago or 2 years ago, 3 years ago, that I need to exit. So, and I think that again, owning a company for 10 plus years should be almost by accident, because it just so happens that I was able to own it for that long.
And with your long experience in the industry, it would be interesting to hear your perspective on how the market has evolved in the last decades and what that means for investors.
Yeah, when I began my career in the early 1990s, I was doing my analysis to buy or sell shares of a company, and I would kind of sell the shares basically to a person across the street, maybe at Putnam or Wellington. That fundamental, I would say person-driven to person-driven transaction is happening less frequently. In certain corners of the market, the most potent buyers and sellers are these, new entrants. They are more rules-based and seemingly what I think basically less human. We noticed around 2011 or so, something was basically happening in the markets that was making, the companies or the market a little bit less, people driven. We noticed that around 2011, there were more ETFs, more quant funds, more rules-based kind of strategies, more mechanical strategies becoming bigger players in the markets. In fact, by 2016, I think the number of ETFs actually eclipsed the number of publicly traded companies, and this had consequences. One of the things we looked at was a correlation to outperformance, and we found that traditional factors was beginning to have minimal impact to outperformance. Those historical opportunities of these factors were basically being more arbitraged away. In other words, if you were to pick the best performing stocks in the S&P 500 this year or last year, you'll find cheap companies outperform, expensive companies outperform, companies with catalysts outperforms, companies with no catalysts outperform. So basically, it was basically all over the place. And even in a 3 to 5 year time frame, when we looked at this, we said, wow, okay, it's interesting. After 3 to 5 years, it looks like if you buy cheap companies, you start to make outperformance, it starts to become more correlated with outperformance when you go out 3 to 5 years. But when we look a little bit deeper into that, we noticed that it wasn't so much the value, the cheapness that changed, but it was much more that something in the company was getting better, what we call the source of return account employed. For example, maybe there was too much capacity in the industry, and now 3 to 5 years later, there's less capacity, so the company had more pricing power, and that therefore they were able to generate more profits. Or maybe they had a bloated cost structure. It took them 2-3 years to narrow that cost structure down, grew margins. So if you peel the onion and say, okay, where was the inflection point? Yes, you bought a company that had some issues, that was priced cheaply in the market because the market was saying this is not a valuable company because they had these 2-3 issues. When those issues go away, then it becomes a more valuable company. So our thinking is that it's not so much you just buy something cheaply and just wait. Yes, that can work, but you have to understand what the source is doing, or what the source of return account employed is today, and what is likely to catalyze it going forward. And again, as we talked about before, time could be a soft catalyst in that situation. So I think more, I think with more strategies and less stocks to choose from, I think that is going to be it's going to be a little bit more trickier, given the fact that there's more quant funds out there.
So do you go to the smaller companies, or do you go to another pool to find your ideas, or where are you?
Yeah, it's interesting. One of Warren Buffett's letters, this is a Berkshire Hathaway letter. I forget what year. I think it was 2002. He talks about, he rarely talks about his mistakes. And one of the things that he talked about, one of these mistakes, was that I think it was a Mid-American Energy, where he was talking about how focusing on key variables, and that basically you say if you have companies with a lot of key variables, the probability of being right is much less than having a company with 1 or 2 variable. So one of the reasons why I focus on large cap industrial related companies with hard assets and cash flows, because these tend to have 1 or 2 key sources. The smaller you go down in the market cap, the more variables. So with smaller companies, maybe they have to reduce their debt, or maybe they're entering a new market. Maybe there's a product innovation they're working on. So there's all these things going on. And I think that if you could get 3 out of the 5 right, the stock could be up 60%. And gosh, you definitely deserve it. But for large cap industrial companies where they've been around for 50, 60 years, it's usually 1 or 2 key sources. Maybe it's pricing power, maybe it's volume, maybe it's because 80% of their input costs are copper, and copper is going down, so margin expanding. So I tend to focus on companies where they lean on 1 or 2 key sources.
And a trend I want to discuss with you was we have seen that some brand businesses have had problems in recent years. And how do you see those big moves coming that are not quite rare, but sometimes these businesses with few variables get attacked from the outside, so to speak. So how do you keep track on those events?
Yeah, no, that's a good question. And one of the things that I learned early on is that you have to write down all the mistakes you're willing to live with. And this is a very powerful exercise, at least for me, to write down, these are the things that it's okay. I buy a company and something happens in Congress or in policies, and they change the whole structure of an industry or something of that nature. That, okay, well, that was not, that was not the reason why I buy it, and that, it comes out of left field. But at the end of the day, if you think about value investing, we're really buying business track records. That's what we're buying. And the problem is that if whatever that you've described has happened before, the company should give you a sense how they handle it. And that's part of your decision making in terms of whether you want to own this business or not. That at the end of the day is what we're trying to do. Buy companies with good business track records. That's why I like working and looking at large cap industrial related companies that have a 20, 30-year track record. I could see how they perform during a recession as interest rates are rising, falling, new administrations or new global politics. And so I could assess those, and I could assess how the business functions. Newer companies, not so much, because their track record is much smaller. So to answer your question directly, it really depends. Is it on the list of things that I definitely do not know that would have happened? And if that's the case, I just get out of the company. Maybe there's a large fire or something of that nature, or something happens in the company that was, or maybe there's CEO did something that's really tanking the stock. Then you just kind of get out of it. But all other things, I think, the business should have some kind of a track record to be able to assess the situation.
It seems like the Buffett way on, betting against change and not on change. Would you say you have a similar approach?
Yes, I would say that. I think that's a good way of putting it.
So you say you document all your decisions. How do you do that? Do you have a systematic approach to it?
Yeah. So the way I like to think about it is that you want to invest in a system, right? So that system has to have some kind of guardrails. So it's not so much documenting every decision, but more or less having a framework. But what I do write down is obviously the reason why I like the stock and things of that nature. But on the other hand, I also write down for all companies, not individual companies, but all investments, things that it's okay for me to be wrong, quote unquote, wrong on. Tax rate was higher this quarter than they expected, because we're not trading, we're not daily traders, so that's okay. Sell side analysts downgrades the stocks, and the stock's down like 3-4%. That's totally okay. We could totally live with that. So there are certain things that's totally okay. What we cannot live with is are things that's basically in the history of the company, whether it's the company does not perform well when XYZ happens, and XYZ is happening, and we're buying more shares. And why are we doing that? So to be able to look back and say, okay, this is the track record and this is what we're buying, is a very important tool that we use here.
And we know that you have studied what factors that are most important for returns in the next year, and that's not price, which is a bit surprising. Can you talk about that?
Yeah. So, look, at the end of the day, it's really about focusing on fundamentals. Not so much kind of factors of, but really fundamentals. What I like to call the deep reality of a business, which we believe is the source of return on capital employed. This is the basis of basically our decision making, because we found that the source of return on capital is most correlated to our performance. Large companies are basically, as I mentioned, kind of like proxies for one or two key sources. It could be pricing power, it could be company competitive win rate. for example. And if you specialize, or Buffett would say, if you have a core competence, it will give you the ability to boil down these large, complex companies into one of the key sources. Maybe the company you're buying is you're really buying steel, or maybe you're really buying a company with a good tax system. It could be where you're really buying a company where they have a monopoly in a certain market. So really, to understand what is the real source of return on capital employed is very, very important. And we noticed that about 85% of a company's return on capital employed is born of a subsector. So you'll see a lot of companies within same subsector, particularly in the large cap industrial kind of related companies, they all will trade together. If you're a large company and you're able to raise prices, chances are your next competitor will be able to raise prices as well. And management adds about 10 to 15% upside, or 15 to 20% upside to return on capital employed. Maybe the company has a better culture, maybe they have better procurement, maybe their location's a little bit different. But by and large, 85% of a company's return on capital employed is born in the subsector. And if you can understand the source, you're basically a large part of the way there. So I would say that, understanding a company's source of return on capital employed is most important. And it's interesting because one of the questions that I would ask interns when we interview them is, if you were to have a stock portfolio to lose money, how would you do it? How would you do it? Would you short, expensive companies? Is that how if you just wanted to lose money, how would you do it? I mean, I think shorting expensive companies would be a problem, right? Would you just, short cheap companies? Well, that doesn't make any sense either. And those are two factors that people talk about all the time. Oh, I bought it cheap, or I bought it. So how would you go about putting a portfolio where you want to lose money? And this is something that I think Mauboussin talks about this a lot in terms of luck and skill. If you could lose on purpose, it shows that you have a little bit more skill in the game. And if you think about it, can you put a portfolio together where you lose money in a month or two? And how would you go about doing it? My guess is that if you think about it and you start to pull it together, you start to talking about the source of return on capital employed.
I've heard about that the short sellers' track record isn't too good. Maybe not that they lose on average, but that returns are really, really low. And maybe that's a proof of what you're saying.
And the market is not a non-zero sum game as well, or hasn't been historically. And when you calculate the return on capital employed, is it a conventional way, or how do you go about it?
Yeah, that's a great question. So, it's not. So there's different ways. If I calculate one way and I get 30%, and you calculate another way, you get 33. If you have the CEO of the company or CFO of the company, they get 36, and basically it's all over the place. And it's not so much the number; it's really the source. So if you ask, let's say, a CFO of a company, and they say, hey, Jill, what's the return on capital employed of the company? And they say, well, she'll say, okay, it's about 28%. And I would say, do you think you could get it to 32? And they say, yeah, I think we get it to 31, 32 at some point. And then I ask her, how will you get it to 31, 32? Now she will start talking about the source. Maybe she'll start talking about, well, we need to raise prices. Or she'll say, well, this input cost is really draining on our returns. I think that it's peaking. We're hedging here and there. And I think once that comes in a little bit, you'll start seeing margins expand. Or it could be, where we have a really bloated kind of, cost structure. Our new CEO has come in to put a plan together to get us back in line. And that's how we could get there. That's the source. So the fact that it's 27 to go to 32 or 16 to go to 20, the number isn't really that important. It's really the direction and the source of how it's going to get there.
So in the book, you mentioned many profitable investments, but you also mentioned now how Buffett talks about his mistakes. So we're curious what your biggest lessons are from when things not play out as you want them to.
Right, exactly. Well, okay, I'm not going to give any names, but one thing I'll give you two big lessons and how I try to fix them. And my two biggest lessons that I've learned over the years was in the bucket of business and the bucket of margin safety. So, I often get businesses wrong. So it could be that I believe that this company really has pricing power. They have XYZ going for them, and something changes in the marketplace. Or I believe that, I don't know, Amazon's not going to enter the market. Then, 2 months later, they're into the market, and so kind of getting the businesses wrong is something that that happens a lot. And so one of the things that that over the years that I tend to do is, and this is what basically I learned from Madam Index, was looking at what I call galopolies, companies that are monopolies, oligopolies, duopolies, companies that basically have some sort of market share or some sort of power among where they operate in. And so, and I found that that's been very, very helpful in terms of, when something happens from left field, they're able to protect their share or participate in it. So that's one way that we try to focus. And also what I said earlier about buying business track records. So, I tend to stay away from, companies that are a little bit newer, that we may not know how they perform in, let's say, in a high inflation environment, for example, or a company where interest rates going up or down, or things of that sort. So, so it's really understanding, having the track record of the business, I think, is very, very important. The other area is really about, margin safety. And what I learned there is that, margin safety often needs a little bit of backup, and that lends into portfolio construction. It's kind of like, you buy a stock at $23, you do your analysis, you think the, liquidation value or what have you is around $18, and so you buy the stock at, you buy a stock around $19, downside at 18, and then the stock gets cut in half, right? Something happens. Now, what do you do with the $9 share price when your margin safety was 8? Well, you could do thesis creep, and we have a new margin safety. It's not $7. It's like, but that's not the most prudent thing to do. Margin safety does not know anything about the macro, like a pandemic or adverse industry events. I talk about, someone like, Amazon, like going into, I don't know, the grocery business or something like that. They try to have the whole sector get down by 40% in one day, or people decide they don't want to go to shopping malls anymore. They just want to stay home and buy things online. So all sorts of things can happen. And what happens to your margin safety analysis? One thing I learned running absolute return strategies is over the past decade or so is to panic early. And having the right portfolio construct to assist you in margin safety analysis should always be considered. Having a portfolio construct where perhaps you have smaller positions, maybe you have a long and short book. So you could be able to hold on to some of these really good companies when situational things happen that adversely affect the stock price.
So going in a bit to your current role and you as a money manager, I would like to start to ask a question about the subject that I feel is a bit underappreciated. So as different mutual funds fit different investors, different stocks fit different types of investors. But reading the financial media, you often just get a list of stocks to buy. These are the top names this month or so on, without any nuance. So What's your view on that, and how do you make sure that your investors are aligned with your strategy?
That's a great question, and I think that's actually I believe Buffett's biggest advantage, having that alignment. One of the things I learned early on in my career is that there are many good ideas out there, just fantastic ideas out there, but I may not be the best owner for that particular idea. It could be a great strategy, it could be a great way to run money, but I may not have the right temperament to execute it. I may not just be wired that way. I observed early on that, the most important decision I will ever make is to decide which arena to enter. Are you going to enter the venture capital arena, the value investing arena, the growth arena, the trading arena? The key is to pick an arena, an investment style or strategy or an idea that really fits the personality, that fits your own personality, and that you could basically win with. I tell young people all the time is that you need to combine your real self with your real skills and your real temperament. You have to combine those three things. And if you're not your authentic self, maybe you don't like waking up early in the morning, so you may not want to run a global portfolio to trade. That just may not fit you well. You may be really excited about being active daily. You may get bored being a long-term value investor where you're buying good businesses and just reading newspapers and you're reading company annual reports all day. That just may not be it could be a great strategy, but it doesn't fit your temperament. It doesn't fit your skill set. Your skill set may be totally different. So you need to align those things. And I think that's one of the things, and I think you said it very, very well. And I think that's one of the things that I think people don't fully appreciate when they hear ideas. And one of the things that we do and we think about all the time is that XYZ could be a great company, a great idea when you hear it on TV or you read about it, but does it fit our portfolio construct? Does it fit what we're trying to do? Will I be up all night worrying about what's going to happen that part of the world, or will I worry about the accounting because I'm not a forensic accountant? So the idea have to fit your skill set and also your temperament.
And at Ocean Park Investments, you have 2 funds. How are those strategies?
Yeah, so we have an absolute return strategy, which is more, the goal is really to compound capital, at risk-adjusted levels and with downside protection. And the other, which we plan on launching hopefully this year is really, it's more of a private equity approach in the public market. It's more of a active ownership strategy, and we call it the Ocean Park Omaha strategy, which is really buying one or two good businesses, perhaps working with management teams and owning it for the long term. It's basically what I was doing when I was working for Michael Price over some time ago, working with management teams. So again, it's 2 different kind of strategies, 2 different types of investor profiles, but at the core, the skill set's the same in terms of trying to understand what really make companies spur stock price appreciation and with different time horizons.
And in your daily life as a money manager, how are you spending the time?
Reading. That's basically what I do most of the time. I'm reading and also kind of learning more about the businesses and the environments that they've operate in. Lately I've been doing a lot of reading on how the ocean and how the ocean has really been kind of a bathtub for carbon emission for over the years. Partnering with industrial companies. We put all this stuff in the air, and how the ocean has really been absorbing that. But the problem is that the ocean gets a little bit warmer. As they take in a lot of CO2. So, you see that this doesn't help the fish, and it really hurts a lot of these lesser developed countries as well, island countries, in the warmer, ocean kind of changes weather patterns and things of that sort. So, those are things I've been kind of talking to management teams and about and learning more about, and seeing how best to make sure that our portfolios are really maximizing the opportunities that I think the whole ecosystem and the environment will present itself in the near future. So I'm really, really excited about this, and I think the industrial-related companies, they're right at the center of this. I mean, some companies are so far behind on these things, and also it's also about risk mitigation, right? So if 80% of your input costs is coal, it's either going away or you have to pay a lot for it. And if you're not ahead of the curve and converting your plants and equipment to use more clean energy, that could be a problem. So I'm really excited about what's to come in that area, and so those are the kind of things I've been focusing on lately.
And do you try to put a figure on that? I mean, do you try to put a figure on the externality that these businesses create, or is it more like a binary approach where you say, okay, this is not this business is doing something harmful for the environment, so I pass?
That's a great question. So we're for us, it's really about how does it impact the source of return on capital employed, period. And so, for example, if you have a cement company, and there's going to be so many. I think Bill Gates mentioned that there's going to be a new Manhattan built every month for the next 40 years. If you look at all the global construction that's going on, or likely to go going forward. So if you're a cement company and you have and you're carbon neutral, chances are you're probably going to gain market share. Chances are governments and companies are probably going to buy a lot of your product because they too understand the need to lower the carbon. And if you're not, if you're not carbon neutral and you're doing things the same old way, you probably start losing market share. Perhaps if you're carbon neutral, perhaps you could, charge a higher premium for your product. So that's a direct way that those things impact the source of return on capital employed. Pricing power, or competitive win rates, or input costs going down. Clean energy, is that cheaper than coal? I believe that it is, and it will continue to be. So if we could pinpoint how it impacts the source of return on capital employed, we're all over it.
It's interesting with those businesses that are of a threat in that way. And I was reading, when you talk about cement, there's an American company, I think, who is creating biocement, and they're like growing it in some way, which is super organic. And that becomes, even if like the normal or the old company is now carbon neutral, they are now facing a threat with a whole different substitute product that is maybe so much better.
And Clayton Christensen talks about these disrupting and sustaining technologies, and I guess you would never buy such a company, right? The disruptor, or
look, that's a great question, and again, I think you can make a lot of money buying disruptive companies. It's just not aligned with who I am and what I do. I'm I'm not a venture capitalist. Like I when I was in business school, I think for the summer I looked at the private equity area and the VC area, and I'm an engineer by training. So in undergrad, I went to engineering school. So I'm a very kind of logical, like I need to see the numbers add up. And if you walk into my office and say, I think we could send a lot of people to the moon, it just needs to, I'm a little bit too overly logical. So Not to say that's a good thing. I mean, it is what it is. So that's why I lean towards companies that I could at least assess historically how they perform a certain way. And look, I mean, it's kind of like what Warren Buffett says. Investing is not like gymnastics. There's no style points, right? If you're going to generate 12-20% returns, it's 12-20% returns. You could say, well, I bought this and that, and I did options, I did this and that, and I could say, well, I just bought this company because they were able to raise prices, and so that's what I try to focus on. And incidentally, a lot of those companies tend to be less crowded. They tend to be overlooked, and I know that you guys are in Europe right now, and so in the U.S., as I'm sure you guys know, like in the West Coast is like where all the technology companies are, like Silicon Valley and all the VC players, and also in the East Coast as well. But so we're in the West Coast. I used to think that I sometimes say that people fly over, Middle America, which is where a lot of industrial companies are, kind of the Rust Belt and a lot of trucking companies, to go to Silicon Valley, so a lot of those options are not very, very crowded. Chattanooga, Tennessee is kind of like the Silicon Valley for truckers and logistic companies. People don't know that, or do they care? So again, that's where I'm very comfortable. And one of the things you want to do is stay in the arena that you're most comfortable.
And did you learn that from experience, or was it early in your career?
I think it was early in my career. I think part of it is starting out as a value analyst, working with people like Michael Price and people who would focus on balance sheets and cash flow. And it's hard to be a value investor if there's nothing really to analyze, or if it's more about the future as opposed to the past. So that's why I like to say that value investing is really about buying business track records. And the longer the track record, the more I could assess and I could assess the risk that I'm taking. And
we know that another principle of yours is that you don't share investment ideas with others.
Well, yeah, I mean, shares is hard. It's by experience, but I think I think for me it's really, I would say it's really two issues. There's a behavioral issue to it, in that it could kind of affect the decisions I make with the portfolios. For example, like promoting a situation that we're involved with creates some kind of bias. And also, a lot of times when people share ideas, really, they want the more complex kind of companies where, right, the really company that has a lot of hair on it, very, very interesting, and it's really fun to discuss. And I think that it encourages kind of, some sort of like smartest person in the room kind of syndrome, where I got to show this, like how I was able to decompose the balance sheet, and like there was this off balance sheet thing going on, and the management was turning over, and I had to figure out what the interest rate and tax rate was. So this is, you want to, do that to show how brilliant you are. And we tend to stay away from that. In reality, some of the best ideas, as I mentioned, it could be, is often like boring situations that are just, that the market just ignored. And over a year or two, you look back, well, wow, this company was up 30-40%. They didn't do anything spectacular. It's just that they were able to raise prices. These decisions sometimes become, when you talk about them publicly, they sometimes become harder and harder to change when the facts change. Remember I talked about earlier about how owning a company for long term should be an accident. It should be because you're reevaluating it periodically, and it just so happened you own it for 5-10 years. But if something changes after a year or 6 months or 9 months, then you need to be able to get out of it. And if you talk about these companies all the time, it's just harder to do so. And the other thing I would mention as well is that the person who's getting the idea do not have the complete picture. It's incomplete. So, we have a portfolio construct that may allow us to hold on to companies that may have a drawdown a little bit longer than, a mom and pop, right? Maybe we know that temporary drawdowns are okay, and maybe we're buying more, or maybe we're just letting it sit. Versus if you're kind of more directional, if we have a long short, hedge book, and the market is down X percentage, and we're kind of flat or so, or down just a little bit, maybe we're adding more. Whereas the directional investor who bought the stock is maybe they're down, 20%. So they don't really have the full picture. And this was a decision I made, not too long ago after, I made a presentation on a short idea actually in a Bloomberg conference, of a well-known company. I'm not going to mention here. The idea was basically down at around 70% last year or something of that nature, but it took a while to work. And during the time when like it was hovering, going up a little bit, it's like, I told everyone how this company was going to implode and things of that nature. I give all the credit to people like, Bill Ackman, who was able to have the stomach and the temperament to make these kind of public announcements and things of that nature, but not for me. I think I will, probably at Ocean Park. I think we probably do so when we see a very clear benefit to stakeholders. The short idea that I presented not too long ago. The company wasn't doing anything wrong. They weren't like hurting the planet or anything like nature. It's just that the numbers didn't add up. So in those situations, it's probably best to just kind of like do things quietly. So anyway, that's how I kind of fell into that. So it's basically by experience.
Yeah, the behavioral aspect is really strong there. And also talking about these different biases, what would you say are your most common ones?
I think sometimes, although I focus on business track records, I tend to try to lean into, talk about what's going to happen in the future, and I have to like keep myself from doing that. I am not good at timing or predicting the future. Now, it may sound a little odd to hear that from an investor, right? Because like, geez, this is all they do is talk about the future or think about it. But I cannot tell you, how much the electric vehicle market will be, how big it's going to be, and who will be the winners, or if we are going to be taking vacations to the moon or spending our weekends at the in the metaverse. We might. I couldn't tell you when. I don't really know. Look, like I said, I'm not a venture capitalist. I buy business track records. I know in the future people will do things like eat and seek shelter, and they will like meet friends and loved ones. I kind of think of myself as the picks and shovels person. Buying companies that provide the components to make these things in the future a reality. Like material companies to help make car batteries last a little longer, or logistic companies, or like one of our longest investments had been a high-tech tractors for farmers. People have to eat, and I know that they'll people will eat in the future. So I try to catch myself when I start pontificating on too much on the future and what will happen, and try to figure out, okay, if it does happen or does not happen, how can I participate based on companies that's been around for a long time, and that I could assess their likelihood of being successful.
Yeah, and a chapter of the book that I really like is the one on emotional discipline. And I was wondering if you can define that for us. What is emotional discipline?
Yeah, so one of the things that Buffett talks about is kind of taking your emotions from corrupting a framework. So it's really about having a framework to make decisions first and foremost. It could be a checklist, or it could be 5 keys of areas that you look at in companies, and it's really understanding that it's really about process over outcome, right? So if you think about the process versus the outcome, and a lot of star athletes and also great teams and coaches talk about this a lot, about just focusing on the process. yes, you will win some games, you will lose some games, but if you focus on the process, let the process make the decision. So it's really about process over outcome. So if you have a process and you're not disciplined and emotionally disciplined to execute that process, then what's the point of having a process? So emotional discipline is really about having the wherewithal to go through a process towards the end. You could improve upon it, but you should not let your emotions corrupt it, that process.
And do you have some other advice or inspiration for how to become a better thinker, better investor, or live a better life? Some principles in your life, maybe.
Yeah, I think thinking independently. I like to say don't put inertia ahead of wisdom. Just because everyone else is doing it. Now that doesn't mean that it's the right thing. It's not the right thing to do. Look, if everyone is running away from a burning building, then it's probably a good thing to do so as well. But you need to understand that. Look, you need to assess the situation yourself as well. So inertia is all around us, and particularly these days with social media and there's so many opportunities to look at companies and things of that sort. So to really focus on your own personal wisdom. And wisdom is really about an aggregate of people that has been successful and learning the best qualities from them and learning the best qualities and based on your own temperament and putting it together to make your own decision. I think that's very, very important. And the other thing I would say is, kind of keeping it simple. And this is the whole point that Buffett often makes as well. And I think if you could explain your investments to a 12-year-old, why you own this particular company, I think it's a very, very good exercise to do every once in a while.
This being a book podcast, we want to talk a bit about your reading habits. And I mean, both me and Eddie read a lot because we want to be better thinkers, better investors, and live a better life ultimately. So, what books have shaped you?
Yeah, I would say first and foremost, basically the Buffett partnership letters. And that's you have the annual, the Berkshire Hathaway annual report, but I'm talking about the partnership letters. I think those are superb, and I think he goes a lot of details in terms of how he's thinking about the companies at the particular time. And I would say investment letters by current practitioners, thought leaders like Howard Marks, John Rogers, Bruce Greenwald at the Columbia Business School, obviously, Michael Mauboussin, and, certain family offices, anyone that you would think would be, I would say, kind of in the first ballot Hall of Famers, in the value investing world. I would definitely read their stuff. So, but in terms of, kind of favorite books, I would say, Creating Shareholder Value by Rappaport, he was written some time ago, is one of my all-time favorites. And also the book that he and Mauboussin wrote, and actually Mauboussin, I believe, was in your podcast not too long ago. The book that Mauboussin and Rappaport wrote, it's called Expectation Investing. It's phenomenal. It's a very detailed book in terms of it's almost like a step-by-step, or it really gives you a really detailed look in terms of the analysis, in terms of looking at, companies and also looking at the market. I think one of the things I got from that book was really about, how's the market thinking about this stock, right? Because no one cares what you think about it, right? How's the market thinking about it? And it kind of links into what I said earlier before about if the dynamics of the markets are changing a little bit in terms of there's more quantitative strategies out there, more mechanical strategies, more ETFs. Is the market looking at certain companies a little bit differently than they were 20, 30 years ago? So I thought that book that's something that's on my shelf, and I kind of it's dog-eared and everything, and I kind of refer to it from time to time. Another one is Investing the Last Liberal Arts by Hangstrom. That's also a good one. Another one I would also highly recommend, which is not really often talked about, is The Psychology of Risk. And it's written by Ari Keeve. Ari is he actually worked at SAC, the 0.72 of the formula SAC. He was basically the psychologist that would work with a lot of traders and portfolio managers. And I had a chance to meet him. He actually wrote 3 different books. And I had a chance to meet him locally here on a number of occasions. But the book, The Psychology of Risk, is very, very profound. And this was before this whole movement on behavioral economics. And basically, he talks about how he uses a lot of the psychological and mental game and mental training that a lot of athletes use. And he shows how a lot of it is very similar. And it's I think it's a very powerful book, not only for value investors, but also growth investors. And as you could, the firm that he was working with at the time, there were several different strategies. So I would definitely recommend that. And the last one I would say is Klarman's Margin Safety. You have to spend a couple $1,000s these days to get a copy, but if you could get a hand on Margin Safety, it'll be definitely worth it.
There's usually a lot of value in books compared to the price.
Yeah, exactly. Yeah.
Thank you so much, Dennis, for taking the time to come on the podcast and share your thoughts on how to become a better investor. And before we finish up, where can our audience follow you?
Yeah, so I am not. I don't have a lot of social media kind of presence. I am on LinkedIn, so if you could shoot me a message, I'll be greatly appreciated.
Thank you so much.
Great, thank you.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.